Most traders lose money because they skip one simple step before they click that buy or sell button. And every pro trader I've studied does this first thing every morning before marking zones, before checking news, and before taking a single trade setup. Let me show you step by step. Very important, you need to study the entire previous day's data, candle by candle, before taking any trade. And here's what you need to look for. You need to look for how price moved, where liquidity was grabbed, where buyers and sellers got trapped. The reason you need to do that is because 90% of the time, today's price movement depends on yesterday's entire day's price movement. Why is that important? Well, this is important because this guides whether or not you should trade and which trend direction the market will potentially take. Let me show you in details with practical examples. When you look into this chart, this previous day started off with a downtrend. And if you pay attention how strong the bearish candles are, then this means that this bearish trend was very strong. But then something happened. All of a sudden, the trend that was strong going down completely turned around and became a very strong uptrend within the same day. And also notice that this new uptrend has gone past the start of the downtrend. And what's even better is that all these sellers that were selling hard on this downtrend ended up being trapped by these buyers, especially in this area. And another important thing to note is how strong the uptrend candles are going up. That means that the buyers are sure of the up direction. Now let me show you how to use this information to our advantage on the current trading day. So when you have a positive analysis of the previous day's data, like in this example, now on the current day, you need to start drawing your key levels starting from the previous day. Why are these key levels so important on the current day? They're important because they are going to help you identify the areas of interest where you would be looking for signals that suggest the continuation of the uptrend. Then once you see a bullish signal on the key level, then you can take your buy trades from there. Now let me show you an example you should stay away from. On this 1 hour chart of the previous day, you will notice that the market started off with this smaller uptrend, and all of a sudden this uptrend turned around and became a downtrend, which appears strong if you look at these candles. Now look at this twist that happened. This downtrend quickly turned around and became an uptrend again. And now if you pay attention to this uptrend, it started off with some powerful candles, but it didn't continue to go higher than this downtrend. Instead, it stopped at around 60% of this downtrend. And look at how the day ended. This uptrend ended the day by having this small pullback going down. Can you see how this entire day's data is not clear? It's very hard to tell which direction the market is going to go based on this information we just analyzed. Now let's look into the trading day and see how the market came out. Can you see on the current day how the market is not taking shape? It's just producing candle wicks that are not taking the market anywhere, just moving around without going forward or without picking a clear direction. So the important takeaway here is that the previous day is an indication of whether you should be looking to trade the instrument or not, and which direction the trend is potentially going. So that is why it's so important to analyze the entire previous day first. And if there is no clear direction of the previous day's data, like we just observed, then don't trade the next day. It's going to be problematic for you.